and Don Jarecki. I'm sure most of you know or have heard his name or met him, hopefully face to face. Chris Bullock, Carmen Scott. I don't think they're on right now. They may jump on here before long. We got 23 slides. Now, why I mention that is I usually start off every one of my little presentations with how many slides there are. That's the first thing I want to know when I sit down for a presentation. We're going to try and keep it about an hour. And I'm going to try and keep pretty tight to that, but we've got a lot of topics to go over. I'm going to try not to spend like 5 or 10 minutes on every slide. This is more or less, the idea here is really all agents know a lot about mortgages, but some people just know some buzzwords like what is a recast, what is assumable, why is this important to me, or prepaying mortgages. If you have a mortgage yourself, there'll be some little things to pull out of here. Please don't hesitate to ask questions. Just unmute yourself and fire away. Don, if you don't mind, keep an eye on the chat box.
Or enter in the chat, and I'll answer as best I can.
Cool. And if you like, if you want me to send a copy of this presentation out to you, just shoot myself or Don a quick email. I might have some flyers, which I may or may not pull up as we're talking through here, but we'll go ahead and get started. So as I usually start these off, just to give a quick talk about where we're at in terms of interest rates and the current market and such. So 30-year fixed right now, up a little bit. I'm going to breeze through this one pretty quickly here, but 30-year fixed is back in the mid sixes again. Very likely to inch up a little bit more as we kind of get closer to the Fed meeting, which is in about 2 weeks. At that point, the Fed's going to bump the interest rate 1/4%. May see rates move up, move down a little bit after that. And then May 10th is going to be a big day. That's the next big inflation report coming out. So we may see numbers improve there and hopefully rates to follow. But why I just pulled up this slide just to give a little bit, everybody is hypersensitive about interest rates. Doesn't matter if they're at 7% or 3%, everyone is crazy about them. So this just shows where rates have been over the past 5 years. Now, the important thing here, this is the last 12 months. This is still a pretty wide spread compared to what we usually see over a 12-month period. But to be honest, when you see a graph like this, you're like, yeah, we're slightly above the middle of the highs and lows here. So this just kind of goes to show anybody who's in the market now, they've heard about interest rates at 2.5% and 3% and 3.5%, but they haven't seen them. Rates have been over 5% for 12 months. They've been over 6% since last August. So buyers in this market right now, people more recently have seen a 7.4% interest rate than they have a 5.99. So just to give a little bit of weight about, hey, everyone's worried and focused and going to be asking about interest rates. It's a constant topic. Hey, if you're a little dinner party, want to spark up a conversation, talk about interest rates. It might not be the most exciting conversations, but you'll have plenty of participants. So, so the topic what we're looking at today is sort of, you want to be an expert in this market, but really every market, obviously. So we're going to touch on all of the items you see here, and then there's a second portion kind of on the back end, more about having a mortgage, some different things to factor in. So ARMs, for example, we're going to talk about that in just a second. I could spend a whole hour talking about those. I had a whole class on points and buy downs as well. So we're going to kind of go through some highlights, give you a little takeaway. And if you remember nothing else from this talk, just know that you can call Don, myself, Chris, Carmen, any of us, and we can go into greater detail with these one-on-one. Or if you're on your way to a listing and say, hey, I told my seller about some seller credits and some creative ways to maybe attract some buyers. Can we run through that again? Or if you want me to talk to a customer direct, we're more than happy to do that. So first one we're going to talk about is ARMs. No, I'm not talking about Don's biceps. We'll save that for the Q&A later if we still have time. These are adjustable rate mortgages. So the simple way of explaining this is an ARM is a 30-year loan, but it has an adjustable component to it. So we'll just talk about a simple 5-year ARM. 30-year mortgage, it's fixed at at whatever interest rate for 5 years. After those 5 years, the rate goes up or down. And if I'm counseling a buyer, I typically say, assume that they will go up. You never know. They could indeed go down. It happens all the time. But the safer, more conservative approach is to assume that they would go up. So the pros here, your interest rate's going to be lower. A 30-year fixed versus a 5/1 ARM might be 1/4 to 0.5% difference in some cases. If rates do go down the road, that interest rate may indeed drop after the adjustable period comes up. Your interest rate could improve, which means your loan could improve. And generally, compared to a 30-year fixed, you're going to be looking at a lower monthly payment during that fixed period. There are limits. So yes, while that interest rate can go up, there is a ceiling. We won't get too much into that, but just know that there are limitations there. The cons, of course, is your interest rates may go up. Very likely, rates can go up after the ARM period, and you may be stuck. You may have no choice, but you may have to refinance as an alternative if you don't want to see that interest rate go up. So it's very, in the market that we've been in here the past couple of years, a lot of people are looking at ARM saying, you know what, I'm going to jump into this. I think rates are going to go down. I'll be safe during the fixed period. And by the time my ARM has to adjust, I'll go ahead and refinance at a lower rate, but you never know if that's going to happen. The other part of where you see a lot of ARMs is someone who's going to be in a short-term living situation. Very common one. Maybe you have, somebody who just graduated med school in Texas. They took a job at the Cleveland Clinic. They're going to be here for 4 years. Well, them doing a 5 or a 7 or a 10-year ARM is pretty low risk because, a physician might say, well, after this, I'm going to move back to Texas, or I'm going to sell my starter home and buy my doctor home, something to that effect. So that's just in a nutshell how ARMs work. Any comments or questions on that? No? Okay. The buy down, we talked a lot about buy downs in the fall. The fall, if you recall, that's kind of when the market was turning a little bit. We started to see it maybe swing. Hey, is this going to be turning back into a buyer's market? How are these sellers going to, take it? How are these sellers going to set their house apart from the rest and get the next one in? At the same time, buyers were still dealing with a bit of shock. Last October, interest rates jumped over 7% when just 5-6 weeks earlier, they were in the low 6s. So what a buy down is, the example I have shown here is a $250,000 sale price for a buyer putting 20% down or $50,000 down. And in this example, it's saying the 30-year fixed rate is 7%. Well, what we have showing here is a buyer, or I should say a seller, giving the buyer $1,600 at closing, the lender, us taking that money and buying down the interest rate 1 full percent for 1 full year. So that buyer has a 6% interest rate for the first 12 months, then it goes back to that 7%. Again, rates are not at 7% necessarily right now. This is kind of just an example, but you can see kind of where, this could be attractive for a buyer. Lenders can do this too. We have options where we can price in a buy down, give buyer relief for 1 year, or as the next slide shows, we can do a 2-1 buy down. So that is buying down, as the example shows here, buying down the interest rate 2%, so 5% for year 1, 6% interest rate for year 2, and then back to a 7% interest rate from year 3 on. The cost of this is a little bit more. It shows the dollar signs right there, roughly $4,700 to fund that buy down. But if you're a seller funding that, that's not even 2.5% of the sale price. That's not bad. So you can hopefully see where we've talked a fair amount about these over the past 6 months. So this may not be new for some of you, but kind of just a quick brush up. Anybody have any questions? Don, stop me if you see anything in the chat.
I got you.
Points. Okay. So we just talked about a temporary buy down. That is where, somebody is funding something to be the rate to be lower for a 1 or 2 year period. So this is a permanent buy down. Buyers can pay points on conventional loans, FHA loan, VA loans. Sellers can pay for points. Realtors can pay for points. Lenders can pay for points. It could be a primary residence. It could be an investment property. It could be a second home. So this is very, very simple, just sort of comparison. But on the left, we have a 30-year, both cases here, it's a $200,000 mortgage. On the left, we have here just a simple 30-year fixed at a 6.5% interest rate. And it tells you the payment there is $1,265, roughly. The interest, assuming they have this mortgage for a full 30 years, is costing $255,000. That's the total interest on that $200,000 loan. Now, in the second scenario on the right, we have a buyer paying 1 point, which is 1 percentage point of the loan. So The buyer is paying $2,000 here. And in this example, they're getting a lower rate of 6.125%. The monthly payment, $1,215, and you can see the interest there at the bottom. So when you compare apples to apples, by the buyer or somebody here paying $2,000, the buyer is saving approximately $50 a month. Over the life of the loan, if they were going to have this loan for 30 years, they're going to save $18,000 approximately. So would you pay $2,000 now to save $18,000 over the next 30 years? Most would say yes. Now, not everybody pays points, and there's several reasons why. First off, most people aren't going to have this mortgage for 30 years. Also, not everybody has an extra few $1,000s to spend to throw at this. My little litmus test of, hey, does this make sense or not? Let's just do a simple math calculation here of if I'm paying $2,000 a month, or excuse me, $2,000 at closing, and I'm saving $50 a month, it's going to take me 40 months, just over almost 3.5 years to break even. So I asked the buyer, hey, are you interested in paying these points for the lower interest rate? Yeah, sure. Why wouldn't I? Well, do you see yourself in this house for at least 40 months? Yes, I sure do. Okay, worth considering. You got the $2,000 to spend? Sure, I got plenty of money laying around. Do you see yourself in this mortgage still for 40 months? And now this is a bit of a wild card. If rates were to drop to 5%, this homeowner very likely would want to refinance and probably won't have this mortgage for 40 months. So now the question comes, all right, would you want to buy down this interest rate for the life of the loan if you're really only going to have it for a couple of years? And that's where kind of the waffling goes back and forth. Well, maybe I will, maybe I won't, maybe rates will go down, maybe they won't. So these are conversations we have with every customer. And points aren't necessarily required on a loan. Oftentimes they're optional, but they're basically there to get a better rate. And the example here, I have 1 point getting 3/8 better interest rate. That's kind of just an approximation. Sometimes it takes a little bit more than that to save that much in rate. Sometimes it's a little bit less. And it literally changes day to day and can change throughout the day, the cost.
Hey, Sean, can I add something on the temporary buy downs, the previous two screens?
Please.
If the reason we haven't seen temporary buy downs the previous couple of years, these temporary buy downs are designed and brought forth when we're in a rising interest rate market. When you're trying to help borrowers with their payments, that's where we get into the temporary buy down versus the permanent buy down. You know, when you had rates at 3%, 4%, 5%, it doesn't make sense to do a temporary buy down. But when you got rates going up into the 7s, even approaching 8s at one point in time where they were last year, that's why you see these temporary buy down products come into play. You know, if you get rates back into the 5s here this year, next year, nobody will talk about temporary buy downs anymore.
Yep. Good point. Cool. Any other questions on the buy down or points? Okay, we'll press on. So I think as most people are aware, the 30-year mortgage is the norm. You hear 15-year mortgage is probably the second most common, but you know what I kind of put up here is a 10-year, 15-year, 20-year. If you want a 22-year mortgage, we can do that. If you want a 12.5-year mortgage, we could do that. So just know when people are quoting interest rates, the norm is 10, 15, 20, and 30-year. So this, I think everybody probably is aware of, but I wanted to put these numbers out just to spell it out crystal clear, the difference here. So on the left, we have a 30-year mortgage, also at $200,000 at that same 6.5%. So basically the same template that we had on the previous. On the right-hand side, we have a 15-year mortgage, same loan amount at 6%. So you're saving 0.5% in interest rate here. But if you look at the payment, of course, it's jumping up $1,687. So the reason you're paying more is because you have to pay this loan off in a shorter term. So you have to pay a lot more towards the principal each month. But if you really never looked at these numbers before, prepare for your mind to get blown when you go to that bottom section there. Total interest. The total interest over 30 years versus 15 years, $255,000 versus approximately $104,000. That is a huge figure. So as we're talking with buyers, whether we're, someone's looking at a 30 and maybe thinking about a 20, or maybe, planning on a 20 and thinking about a 15, these are numbers. I can't speak for all loan officers, but Don, Chris, myself, Carmen, we're going to have this conversation going, hey, yeah, it sounds like you're pretty comfortable 30-year. Do you want to explore what a 20 or a 15 would look like? We do run through these numbers. And if I have somebody who's kind of talking themselves into a 15-year, maybe they're not exactly comfortable, oftentimes I can sense that and say, hey, if you are not comfortable with that 15-year payment, don't do it. You can do the 30-year and pay extra. A little later, we'll talk about loan prepayment. But this is a conversation we have to educate the consumer, basically present them with all options. We don't want to confuse a buyer or inundate them with 1,000 different choices necessarily, but we do want to let them know of every opportunity and help evaluate the pros and cons with them. But I've been doing this a long time. When I put this template together, even I was just sort of like, wow, that is a big difference. Even if someone's planning on only having this mortgage for 5 years, we look at the amortization schedule and the interest savings, it's still a sizable difference. The amount that, these two loans next to each other, the amortization or how much is owed after a 5-year period is still staggering on how much faster that principal gets paid down. Where a lot of people get into this is they start with a 30-year and then maybe, as they're aging or growing into that payment, maybe refinancing down the road, at that point, a lot of times they move over to a 15 or a 20-year. And sometimes you see the opposite. Sometimes you people going from a 15 to a 30. But I don't have many faces here to look at other than Don's, which is great and all that, but I know he's not going to be shocked looking at these numbers. Anybody else out there? Does this kind of catch their eye and kind of an eye opener for them? Cool. All right. Okay, next one. This one is a bit more timely. So we're going to talk about assumable mortgages. Assumable, typically, I bolded FHA and VA because FHA and VA loans have the assumable feature. Some other loans do too. So just to be clear, Fannie Mae, Freddie Mac, 30-year fixed, kind of your normal everyday conventional typically doesn't have this. Occasionally you might have like a portfolio arm that has assumable, but FHA and VA are where you see these in most cases. So just to read what we have on the screen and then we'll go a little deeper. Assumable mortgage can be transferred from the seller to the new buyer. Generally, this requires a full credit review of the new borrower, and the lenders may charge a fee for the assumption. These are not always quick. What I mean by that is, well, let's take an example. Let's say you had a buyer buy a $200,000 house with the minimum down on an FHA loan back, in the thick of COVID, 2020, 2021. And let's say they got a 3% interest rate. Now, maybe they're, maybe they're moving out of state, taking a new job, in North Carolina, whatever. And they decide to sell their house. Well, they've got this FHA loan, which is probably about $190,000 balance or whatever it is at 3%. In your realtor remarks, there's a section, is there a mortgage assumable? I believe there's a little button for you guys to push. I haven't looked lately, but I know you guys used to have that as realtors. Well, a buyer could come in and say, hey, I want to buy your house. And by the way, I hear you have an FHA loan. I'd love to assume that. So there is a process where that buyer could, attempt to, I say attempt, it's like they're not trying to do something they're not supposed to, but go through a process where they can take over the existing mortgage balance and interest rate. Now, let's say that house is being sold for $250,000. If that mortgage is $190,000, the buyer's got to come up with a pretty big chunk of down payment one way or another. There's a few different ways to go about that. But if they have that down payment, they may be able to take over that existing mortgage, but they have to go through the current lender holding that loan. Now, it's not a faster process. It's not an easier process. You still have to go through the normal loan channels. There's still going to be a credit review, an income review. It's not being done by a traditional loan officer. It's being done by a consumer or a customer service representative. Historically, when these do go through, they take well beyond 60 and often 90 days. That right there might, take somebody out of consideration for something like that in this market. Their credit guidelines and review is usually a little bit more strict than even the initial is what we typically hear. But this could be something somewhat marketable. I mean, you have two houses for sale and one says, hey, buy my house and get my 3% interest rate. That's going to catch some attention, raise some eyebrows. Again, the practicality and going all the way through it may not be kind of a slam dunk, but And really, this is the market you see that. If rates drop down to 4.5% in the next 12 months, you might hear a couple of people talking about it. But right now, when interest rates are in the sixes and getting upwards close to 7%, that low interest rate might be an eye opener. But Don, anything you want to add to that?
No, but if you want to, these are not quick deals. If you want to kind of give a little backstory on one Chris had earlier this year.
Yeah, we had one. Chris had a customer pre-approved VA I would say slam dunk, but a very traditional VA loan, and found out that the house had an assumable feature with a pretty good interest rate. And Chris, in so many words, said, "Hey, I can't blame you for taking it. Just if you run any problems, or we can get our pre-approval going pretty quick." So they went with the sellers, called lender customer service, got it going. Took about 10 days, maybe a little less than that, into the process, and all sorts of red flags were going off. Buyer's credit score was not bad. I believe it was in the mid 600s. Well, the customer service rep, as I understand it, called the seller and said, "Hey, this isn't going to work out. You should sell your house to somebody else," which is a serious violation in communication and sharing personal information. Ended up just the closing process was going to take 90 days. Buyer and sellers kind of said, "Okay, well, reluctantly, we'll agree to that." But they didn't like the buyer's credit score and a few other things, and just said, "We're going to decline this loan if it turns into a loan." Long story short, buyer went back to Chris. They closed in about 3 weeks, and buyer lived happily ever after with the current market interest rate. So,
but didn't they also state, Sean, it would have taken 3 to 4 months to process that loan?
Yeah, 90 days. Yeah, 90 days is what they were.
Yeah,
basic. And if they were saying 60 to 90, that probably meant 90 to 120 and maybe even more. And part of the reason is, for the lender who's holding this note, they're not making any more money. They're doing, they're providing a very nice and gentle service to the new customer. So these aren't highly staffed, experienced loan officer, so to speak, that's going to guide them through the process. So, the lender's probably losing a little bit of money in the process. So there's not a high incentive for them to get it done quick and efficient, if that makes sense.
Hey guys, it's Wendy. Hi. This happens quite a bit with investors buying people's houses, assuming the payment, or assuming, I guess that's a little different, right? Assuming the payment versus assuming the physical mortgage itself, right? Someone can assume someone's payment. Is that correct? No. They can't. Okay.
No, you're assuming the mortgage that currently exists on that property.
Okay, so it would have to be in your name.
Correct.
Yeah, got it. Okay.
Yeah, VA, this used to be a little bit more common back in the old days, for whatever the old days, like going back 20 plus years. You used to see a bit more on the VA stuff, because especially there was no PMI, so that probably made it a little bit more attractive. But yeah, it's kind of an all-in process. Like, you might have some, "Hey, you know what, go ahead and we'll do a quick claim deed, transfer into my name, and the mortgage may not need to get paid off." Well, no, it has to go through that process. A buyer can't just sort of say, "Okay, well, you take my payments on the way out," kind of I would say a handshake agreement, something more than that, but the lender absolutely has to be clued in on that. Cool. All right, we're doing okay on time, I think. So almost 1:30 and almost halfway through the slide. I'm feeling good. Okay. Down payment assistance. So this one, again, we could do a whole seminar just on this alone, but down payment assistance is always part of, no matter what the market, especially first-time home buyers, they're the most cases who's going to be looking towards and have access to this. So just to touch on a few options. OFA, Ohio Housing Finance Agency, they're the most common kind of grant provider. When you hear a grant, you're just not going to go to closing and be given, a check for $5,000 on a $100,000 house. There's a normal standard lender review, but then Columbus, the OFA headquarters, also has to approve it. The interest rates are set by OFA, and there's some weird strings attached, because sometimes the OFA rates are higher than kind of your, non-grant rates. So every customer, I had one this morning who said, "Hey, I'm a recent graduate. I get a grant for grant special." I said, "You absolutely do. Here's what your mortgage payment would be if you came in with your own funds. Here's what your mortgage payment would be if you use the OFA." And now, we're not ruling it out. But now he knows, okay, well, if he finds a house in 2 weeks, we're going to reconvene and say, okay, well, what do the interest rates for this program look like right now? The program also requires a first-time homebuyer seminar, which can be done online. I should say seminar, homebuyer class. The closing costs are a little bit higher. There are income limits, but there's all sorts of grants. So if you're a first-time homebuyer, there's one. If you're a police officer, nurse, firefighter, teacher, one of the heroes, there's a different program. If you've graduated and received a degree in the last 24 months, there's a different program. Community First is another one. This one, the OFA program we say it's a grant. It's a forgivable second mortgage. So after you live in the house for a certain amount of time, then you don't owe it back. Communities First is more of kind of looked at as a gift. So there's not a second mortgage necessarily, but the rates are a little bit higher. Chenoa Fund is a second mortgage with a much higher interest rate, but it is eventually forgiven. And then there's a lot of city programs and county programs, nonprofit. I mentioned Greater Circle Living, pretty much the biggest grant going these days. If you have somebody who works for a nonprofit in the immediate University Circle neighborhood and buying a house within that footprint, and we can provide you the detail on all these programs, you can get into a $30,000 grant. So years ago, I had someone buy a $75,000 condo with a $30,000 grant. So no PMI, of course, and it was phenomenal. That person sold their house about a year ago, I believe it was. We did their loan. They had paid off their mortgage in the time that they lived there and sold this house free and clear. Essentially, just got handed $30,000. So there are some great programs out there. The important thing to know on these, a lot of them, not all of them, but a lot of them are income based. Some of them are based on where the property is, zip code, city, county, etc. Some of them, like Lakewood has a program, Euclid has a program. So some of these, and these programs come and go. They may fund this program the first of the year, but in April, if all the funds are gone, it's gone. So these things do come and go. But if you as a realtor want some, have a separate conversation, or certainly have a buyer who you just want us to consult with directly, feel free to reach out. But any questions on the down payment assistance? Don, anything you think I missed there?
No, I thought you caught it all.
Okay, cool. Seller concession. So I think everybody knows, the seller, seller concessions are normally the term we use, but realtor can also give concessions. So I know this isn't something a realtor is going to run towards, but if a seller, says, hey, I know you want $3,000, I'm only going to give you $2,500, and the buyer says, well, I just can't make that work. Realtor can kick in a $500 credit. Or if a realtor wants to pay for a home warranty as a gift, or there are ways, but just so you know, when we say seller concessions, we just mean total concessions. So looking on the right-hand side first, seller paid concessions. These are the limitations for how much a seller can provide to a buyer. 6%, and that's 6% of the sale price. So on a $100,000 loan, you can get a $6,000 credit from the seller, which should be, depending on the buyer's qualification, should be more than enough to cover all the buyer's costs and funds. Now, keep in mind, you have a $200,000 house, 6% is $12,000. That is a lot of money. There's not enough closing costs and prepaids to spend that on. So if the money is there for the taking, there's other options, that we'll talk about on the left we can look towards. Seller limitations on a conventional, it's 3%, 6%, or 9%. So if a buyer's putting less than 10% down, you can get a 3% credit. If it's 10 to 20% down, max 6% credit, and then 9% credit, which I don't think I've never seen that before, but these are things that we would usually, as we're doing pre-qualification, pre-approval, communicate with the buyer and, of course, you as the realtor, what may be necessary. If you have an investor buying, the limit is 2%. So $100,000 two-family home that's going to be purely a rental, seller can give back $2,000 towards the buyer's costs, closing costs. And a lot of times what we see is, maybe there's no cost negotiated in it, but after a home inspection, hey, I want this, and this fixed. You know what? I'm not going to do that. I'm just going to give you $1,000. All that is perfectly fine. And then, of course, 4% credit for VA. And this is the one I get this question a lot. my two most common calls on a Sunday afternoon are, hey, I need a pre-approval done in the next 45 minutes. Are you free? And the second question, most popular question on Sunday is, how much am I allowed to ask the seller for closing costs? So just keep those in mind, and always feel free to call us. On the left-hand side, so yes, the concessions can go towards closing costs and prepaid expenses. I think everyone's probably aware of that, but it can also go towards those temporary buy downs. Remember that we already talked about it, but the seller giving a buyer, well, let's walk through a scenario of a $200,000 house. If you got a 5% seller credit, that's $10,000. That's a big chunk of money. That's going to be enough to cover pretty much all of the closing costs and a 2-1 buy down. So working that into the negotiations, there's a lot that can be done with it. Putting money just towards points instead of doing a temporary buy down. Sometimes we only have like $500 left over, $1,000. Well, that might be enough to lower the rate from 6.5 to 6.375. Believe me, a lender will find something to spend these costs on in most cases if it's going to help the buyer out. Seller paid PMI. Now, I have a whole class on PMI. I've been teasing it for a long time because the title is so nice, having a PMA about PMI. So we will bring that out one of these days, but this is a lump sum PMI where the buyer doesn't have to pay a monthly PMI, can just pay one single payment in closing. That could be paid for by the seller. It could be paid for by the realtor, it could be paid for by a lender, or a combination of them. So again, a little teaser for that class. I've been teasing it for a long time. So any comments or questions on the settler concessions?
I have a quick question again. When, through the years, when they say up to 6% or up to 3%, I've always had a hard time with that, because I'm like, okay, is it going to be at 3%? Am I going to be paying 3% as the seller, or is it going to be up to? How would that work?
That's good language, because let's use that example of a $200,000 house and it's a 3% credit and it says up to $6,000. If I'm a listing agent or a seller, I just assume that $6,000 is going to be spent, but it is, and we have had this happen before. Hey, you know what? It ended up only being $5,600. So there's $400 left over. That can't go towards a down payment. That can't go just cash in the buyer's pocket. That money's going to go back to the seller.
I had that happen once at way in the beginning of my career, where it was too much money and I ended up getting that back in the end. Mm-hmm. But it's only happened a handful of times. But when I see that, I always do assume that all that money is going to be used, but sometimes it's not. And I'm just wondering why that is.
Yeah, the verbiage should always be written on a purchase agreement. Like for myself, when I advise a realtor, we can sell our concessions. I will only put a percentage amount down, like 3% for a 5% down or less conventional transaction. Otherwise, I'll pretty much give you a dollar amount to use.
Okay.
And the verbiage should always be towards closing cost, points, and or prepaids. Yeah, I didn't know that. I thought that was an interesting putting the reason a percentage. You said 3% on a 5% down deal is because if it exceeds it by $1, we have to get an addendum changing it. So if you just use the percentage amount, you're covered. And it won't be up to, I'll put 3% total.
Got it. Perfect. Great. Thanks, guys.
I had one a few weeks ago. There's a little bit extra, and on the contract, I'm trying to think how it was. Oh, there was no home warranty, and we had like an extra $400 or something left over. So the buyer said, you know what, I do want to do a home warranty. That added $400 to the closing costs, or $500, whatever it was. And that was in essence added to the closing costs and then paid for by the seller.
Or add a second year to the home warranty if they've already got one.
Good thinking. Yeah, that's actually a real good idea. All right, next one, recast. Okay, this one you heard us talk about a lot since 2020, when kind of the I know everything goes. I always refer to COVID, but I don't know what other name to call that era of just absolute craziness in in the world, but in our business, I think as much as anywhere else. So walk through a quick scenario here. Let's say you got a couple who's selling a house for $200, buying a house for $300. And in a perfect world, someone knocks on the door, buys their house for 200, and let's say they were going to walk away with $60,000. That was how much, sell their current house, have 60 in their pocket, buy the next house for 300, put that 60 down, and good. They got a 240 mortgage, living happily ever after. Well, the pickle a lot of people are in is, hey, this seller's not going to take a contingency. So you're going to have to buy this house, whether your house sells or not. So now you have a buyer saying, okay, well, I can't sell my house. I don't want to sell my house too quick. I don't even have it on the market. So I'll tell you what, how about if I, on this $300,000 house, I'll just scrape up 5%, $15,000 down. Maybe it's a gift from mom and dad. Maybe it's out of their savings account. Maybe it's a 401k loan, but they just come up with that amount. So they have a 285 loan on that new house. Now they own both homes. They put their house on the market. Wendy listed on Friday and has 62 offers on Saturday and Sunday. And now they accept the contract on Monday. That house is selling and it closes. And now that buyer has the $60,000. So now they still have that 285 mortgage on the new house. House is sold, $60,000 cash in their pocket. What they can do is, if it's with CrossCountry Mortgage, call customer service, say, hey, I want to recast my loan. So the buyer, maybe they take $15,000 and pay off their 401k loan or put it back in their savings. The other $45,000 sitting there, and say, hey, CrossCountry Mortgage, I want to write a check for $45,000, apply it towards my mortgage balance. So that's going to take the loan from 284 back to 240 and recalculate, re-amortize the mortgage. Now that payment is going to go down to a $240,000 mortgage with 29 and a half years remaining. Now, in this example, they probably have PMI. Now they may be eligible to get rid of PMI if the numbers work out. That's a separate request. So the buyer has to recast and separately ask for the PMI to be removed. But this is a very common, when I say common, just about every mortgage lender has this, but not many people talk about it. Sometimes there are rules. Each lender might say, yeah, you have to wait 6 months before you can recast, or it has to be more than $10,000. Sometimes the fee is $500 or $700 or $800. It's not a refinance. It's just a simple modification to the existing loan. Takes usually 30, 60 days to cycle through the payments, but this is a great tool. Now, you meet a buyer who, in this example I gave, you have to have a buyer who's able to come up with that 5% and qualify to carry 2 mortgages for a short period. But this is a very, very common technique that makes a buyer feel a little bit better about, okay, well, I'm getting, making sure they're not getting in over their head long term. Maybe in the short term, they're like, okay, this could be a little bit of adjustment for us, but this is a very, very common tool that we're using these days. Again, I know I've talked about this a fair amount over the past couple of years, but does this make sense? Cool.
Mm-hmm.
Don, anything I'm missing there?
No, I think what you touched on the base, exactly what it is. The thing is, if you're looking to remove that PMI, the borrower has to request it. We don't drop it automatically.
Mm-hmm. And does go through customer service. Why I say that, I always tell a buyer, hey, when you're going to do that, feel free to give me a call. I'll refresh you kind of the steps involved and how to get that done. Cool. This one, each column here, I could spend hour or hours on, but just know, conventional Fannie Mae and Freddie Mac, that's pretty much the norm. FHA, I think everybody has a pretty good handle on that. This just shows some of the basics between them. VA and USDA are the go-to zero down programs. If you've got a veteran, zero down pretty much all day long. USDA, for those not familiar, there's income limits. You have to be under a certain income limit, but think east of 306, Eastern Streetsboro, Manaway, south of big parts of Madison, Ashtabula County, somewhat more rural area, they will qualify for a zero down loan. The PMI, there's some PMI, but it's cheaper than FHA. And as a seller, from a listing side, the difference between all of these really is just the appraisal. And I can't tell you how many poor, unfortunate buyers are looked over or not considered because of the dreaded FHA inspection, which usually is a whopping 15 minutes. It's not a home inspection. It's not, I would say it's even less intrusive than a point of sale for those of you listing homes in the Heights area. Veterans, I've seen sellers bend over backwards for veterans, and rightfully so. And I've seen some other people just say, your offer is $10,000 higher, but it says VA. Sorry, come with a conventional offer and we'll take your offer. That means, okay, buyer, instead of coming to the VA loan, go get 5% down, go pay PMI, go pay higher closing costs, then we'll consider your offer. Don, please feel free to chime in here. I know you have some thoughts on this.
No, it's actually pretty cut and dry on here.
Right.
I mean, you only have so much time, so we'll just keep moving forward with it.
Okay. Sounds good. But most of you, I think, are aware of this. Chris, Don, myself, if you've got an offer, whether it's conventional, FHA, VA, you've got an approved buyer with us, more than happy to call a seller, or excuse me, a listing agent, go, hey, we got a great buyer here. We verified income, we verified assets. Obviously, we want to make sure the buyer has provided the documentation. Oh, by the way, this is an FHA or VA. I've been doing this for 20 years. I can give you a good rundown of what we might be looking for. The listing agent, if they've been doing business for a fair amount of time, they probably have a pretty good feel of it, but more than happy to address any concerns. We have a phenomenal success story, and we have Brandon, who I don't know if is on this, one of our newer to the team, had a VA buyer missing out. Brandon offered to reach out to the listing agent just to counsel them just more on VA. If it wasn't for Brandon's phone call, that buyer would probably still be out there making offers. Instead, they closed on their house just last week. You have a direct benefit here with the loan officer willing to make those calls and made a difference here. And he's a hero. The loan officer, the buyer too, but the loan officer, we're getting it done. So just know that we're more than willing to do that. Delayed financing. So this is something that's been out there. A lot of loan officers started putting it all over Facebook, like, hey, look at this. We just created delayed financing. No. This has been out there forever. They didn't have to know it or didn't know it existed, or really, there wasn't an angle to work. But during COVID, again, still in this market, you might have a scenario where, 6 people are bidding on this house. And, a lot of times you have a buyer, maybe who has some deep pockets, or maybe family with cash, saying, hey, you know what? I'll give you the cash that where you buy that you're now a cash buyer. That's going to put you the top of the list if you've got somebody real finicky looking at all the different offers. And when you close on this house, you can refinance and come pay off the loan, depending on what the circumstances are, get that cash back. So this, again, could do a whole class on this, but normally to pull cash out, do a cash out refinance, you have to wait 6 and sometimes 12 months before refinancing. This is an exception to the rule, provided we verify where the money came from. There's some requirements where we base the value off the lower of the sale price or the value, but this is a something, again, it's been there for a while. There's some weird rules about how we have to verify where the money came from. If you borrowed money from a family or a 401k or something like that, we have to show that that debt is being paid off. So there's a little bit more to it, but this has basically gotten buyers into homes by, the cash gets them into the home, but if not for this on the back end, they never would be able to consider it. So more than happy to counsel a buyer. In fact, if you've got somebody going down this road, have them talk to a loan officer before funds are transferred and the house is closed, because there's a lot of documentation that has to be shown how the house was purchased in order to qualify for this. That one got a little wordy there, but does that make sense how I explained that?
Yeah.
Okay, cool. All right, non-QM. Non-QM, very common term in the mortgage world that you may or may not see on kind of the consumer and realtor side. Non-QM is non-qualified mortgage. So qualified mortgage is, think of Fannie Mae, Freddie Mac, kind of your traditional conventional. So non-QM, as I call it, is the outside the box. That's where you have your bank statement loan, your DSCR, foreign national asset qualifiers. So let's say you have somebody who maybe they started a business 18 months ago, and they don't have enough tax returns to show income history, and it's a little dicey. But they're buying a rental property that's going to be cash flowing $2,000 a month, and the mortgage is only going to be $1,500. So we may say, okay, well, I'll tell you what, send us, well, excuse me, I started explaining the DSCR. So the DSCR loan, we can't verify income, or it's going to be a little tricky. We're just going to qualify based on the cash flow. There's enough coming in on the cash flow of the rental. We're going to qualify you just on that. The file, we don't do paper files anymore, but it goes from this to about that because there's no income to document. The rates are higher on this. Credit score requirements are pretty strict. The down payment's going to be 25%, but great way. Bank statement loan, maybe you have somebody who's got a business cash flowing great, but they've got a very, very good accountant who's really, really good at finding all those expenses. And when we look at the tax returns, there's not enough income to qualify. Well, we could say, hey, don't send the tax returns, don't want to know. Let's just look at your bank statements and see how much money is coming in each month and qualify you based off of that. There's a loan for that. Foreign national, someone lives overseas and wants to buy a house here, it exists. 1099, any 1099 employees on this call? Yep. If you're a realtor, the answer is yes. So there's a way where we qualify just on your 1099. A little bit more detail than that, than the DSCR. Non-warrantable account, general one-off, where we say like, oh, this loan is perfect, slam dunk, except for this one thing. This is a place where we put that. Bottom line with these, you're going to be looking at higher interest rates. You might even have a prepayment penalty, something along those lines, but we do have outlet resources for those.
Hey, Sean, this would be considered like a non-agency, right? So agency loan is the traditional, conventional, things like that. So this would be non-agency loans, right?
Correct. Yep.
Thanks.
No, that's right. Throwing through non-lender options. So this would be like seller financing, land contract. I won't go into these, partially because I'm not an expert on these. These are instead of getting a loan through one of us. But still, a lot of times it's sort of like, hey, I'm going to go get a land contract, then I'll come back to you guys. So there's still a lot of planning, rent to own, commercial financing. Anything in our world, 1 to 4 unit is considered residential. Anything over 4 unit is considered commercial type. As of right now, CrossCountry Mortgage doesn't have commercial lending. That may be something coming on the horizon, but we do have resources. We can refer you out if you have somebody looking for a commercial. Home equity line of credits. This is something, we've got some programs there. They're good, but they're not great. We are rolling out some in the next couple of weeks that you may hear about because we're going to have some more flexibility and better options at even some local banks. So I said non-lender options. I mean, obviously that's direct through a lender, but just talking more non-traditional. And then hard money loans. So for those of you who haven't heard, a lot of people hear the word hard money, but don't know where that is. I mean, usually where hard money comes in, someone's buying a house. Maybe it's just too run down, too beat up, too much of a fixer-upper. So buyer says, hey, I got this steal of a deal. I just need 50 grand to buy it and another 50 grand to fix it up. Well, a hard money loan is finding this venture capitalist type or somebody with some deep pockets to say, hey, we'll give you a loan for it. It's going to be a high interest rate. You're going to be paying a ton of points and you got to be out of it within 12 months. So you either need to sell that house in 12 months or refinance or just show up with the cash and pay it off. Again, I don't have any direct resources for that. Some of the guys on here might, and some of the realtors in the office do as well, but just wanted to touch on that.
Can I chime in real quick again? I'm sorry. The hard money loans too, be careful with hard money loans versus private money loans. My company uses private money loans, which is just like an arm's length friend or associate that they can ask for points or a certain higher percentage. Hard money loans are more, they kind of act like a lender like you guys would. So it's not always a slam dunk with a hard money loan. We talked about this in some of our investor meetings, but there's also private money loans too. That'd be like a friend or family, giving them a higher percentage for a short amount of time. I just wanted to chime in there. So. Oh,
please, Wendy, I appreciate that. And this, if you're like, if like sometimes I have people saying, hey, I'm putting a land contract together. Can I ask some questions? It'll before I answer the questions, it'll start and finish with hey, this isn't my expertise. I see land contracts after they're done, but go talk to such and such in the office, a real estate attorney, etc. But no, I appreciate that one.
Yeah, no problem.
All right, so this is kind of switching, just turning a slight left turn just to my little title here. Hey, homeowner, this may help you. So this is good to know as a realtor, but also as a homeowner. I realize many people on here might have a mortgage or might have had one or will have one again here someday. So prepayment. So this a biggie. I mean, everyone knows, yeah, you can prepay your mortgage at any time. Well, I should say most mortgage you can prepay any time without penalty. So what this is a comparison. Again, going to the same scenario we've been looking at most of the, well, actually it's slightly different. So on the left side, this is a $200,000 mortgage at 6%, giving you a payment of approximately $1,200 and then the interest for that over the life of the loan. On the right-hand side, this is someone paying an extra one payment a month, or excuse me, extra one payment a year. So in this example, just sending an extra $1,200 in December, or paying $100 extra per month, or signing up for bi-weekly payments, which equates to one extra payment a year. Look at the difference here. You're saving almost $50,000 in interest, and you're paying that mortgage off in 25 years. So you don't have to, get set up a payment. You don't have to do bi-weekly. You can just send an extra $10 one month, an extra $100 the next month, not pay anything extra. But I guess the moral of the story is anything you pay extra, an extra $1 now is going to be $1 to $1.50 less in interest later on the front end of a 30-year mortgage. So the power of prepayment. Now I always tell a buyer, yeah, if you see the math here, it looks pretty enticing, and a lot of buyers are like, yep, sign me up. First time home buyers especially, hey, build your savings a little bit. Your air conditioning may not turn on next month. You may have a hole in the roof. You want to pad your savings just in case. I mean, something unforeseen could happen with employment or income. So build up a little savings before you go all in on prepaying. But this is a just simple little option A, option B. $100 obviously is, adding 1/12 to your payment is not a little amount, but this is huge. When we're getting into talking about refinancing, this is where you see a lot of people go, you know what? My sister-in-law, she bought right before COVID and then refinanced right after COVID. She went from a 30-year to a 20-year, lowering her interest rate about 1.5%. Her payment approximately stayed the same. She said, you know what? I don't want to do another 30-year. I'm comfortable making this payment. If I could shorten my loan to a 20-year and keep the same payment, I'll do that. Anyway, just prepaying, it's exciting to talk about. There's so much savings there. But anybody have any comments or questions on that? Okay. Next one, PMI removal. So I have a flyer with this too that I share with buyers, but just quickly going over that. These are the different ways where PMI will go away. This is kind of generally thinking of a single family home. If you got a 2-family home or an FHA loan, this doesn't apply, but this would be conventional. So when a mortgage is paid down to 78% of the original value, the PMI will also automatically go away, assuming the buyer's current and all that. So if a buyer, if a buyer started out with a $100,000 loan on a $120,000 house and wrote $50,000 check, yep, payment's going to automatically go away. That doesn't typically happen. It can, but not many people are just stroking a $50,000 check here. Borrower initiated termination, saying, hey, lender, I don't think I need PMI anymore. Customer service will sort of say, okay, well, hey, here are the ways out of it. There's a form letter that goes out. So in this case, I'm in the middle column here. The balance is scheduled to reach 80% of the balance of the initial mortgage schedule. So if it gets to 80% and the buyer asks for it to get removed, it could be done there. Or the value, sorry, here, my screen clicked over. I'm sorry, the next one here on the right. This is where they factor in the appraised value of the house. So if the buyer's been in the house for at least 2 years, payments are currently on time, and the value has gone up to where the buyer has 25% equity, they can get rid of PMI then. Or if they wait till year 5, they need just 20% equity. So let's say somebody has a $100,000 mortgage and, you know, in the first 2 years, they paid it down to 95. That's not going to get rid of PMI by itself. But if the house value went up and it's now worth $150,000, that's going to be worth the cost of the appraisal in most cases to then appeal to get rid of PMI. The buyer doesn't do the appraisal on their own. They have to kind of go through the lender, through the servicer. But PMI is not permanent. So just think, I had a lot of people who bought homes in 2018, 19, who were getting rid of PMI in 2020, 2021, because the value of their house had gone up and appreciated so much so fast. So any questions on the PMI? No. And again, we have this, I have, like I said, a flyer that I pulled this exact information from. We can co-market those. So if you want Don's face and your face to go on a PMI flyer to all of your homeowners that you did a loan, you know, financed or closed the home in the past 2 years, we can do that stuff and help for you. Oh yeah, these are buzzwords: house hack and the BRRRR. I think I'm missing an R in the title there, but house hacking is like, you know, it's the avocado toast. It's the you know, the cool hip terminology to throw around for first time buyers these days. I'm going to buy a 2-family house, live in one side, and have the bozo next door who's renting pay my mortgage for me. Genius. And then, hey, you know what? After I live a couple of years, I might build enough equity, and I'm going to go buy my other house, but I'm going to keep this one. So I got into this house as a primary residence, maybe an FHA loan with just 3.5% down, got a great interest rate. Now I'm going to move out of this and go buy another primary residence. Now in the next home, I'm only going to put 5% down. Maybe I'll live in that for a year, move out, and turn that one into a rental, and, you know, build the rental, you know, empire, real estate empire for that customer. So hey, we're into that. More than happy. I've got a lot of buyers who I've done 4, 5, and 6 loans because they're doing the kind of this house hacking. You know, rates go down, they're refinancing this one, they're pulling equity out of that one, they're running to get a home equity on this one to fund the down payment for the next one. More than happy to talk anyone through those. You know, I've had people approach me about doing seminars just on that. More than happy to. All right, we'll talk about the BRRRR method. I can't remember, it's been years since I've been hearing this, but when I have someone saying the BRRRR method, I used to mean, ooh, they just went to a seminar. Now I just know they Googled it somewhere. But basically, buy a house, rehab it, rent it out, refinance it to pull cash out, use that money cash out to go buy the next one. It's kind of just, this one they may or may not be moving into the home, but this is kind of like, okay, this is going to be doing it again and again and again. And there's some, you know, at 2 o'clock in the morning, if you're watching, you know, ABC or CBS, there's probably some guy selling you, you know, a $500 book or membership to tell you how to do all this. Just talk to your average, you know, realtor. They can guide you through it, or your loan officer, and they can give you some tips and pointers. But yes, house hacking and BRRRR, they're great customers to have. You know, it's a great niche to get into. So refinancing. So obviously everybody thinks, I want to refinance to get a lower interest rate. Yes, that's a big motivator and why most people refinance, for that lower rate, for that lower payment, for that shorter term. Like I mentioned with my sister-in-law, she wanted the lower rate and thought she was going to be excited about a lower payment. But said, you know what? I'm fine with the payment. I'd rather just get rid of this mortgage 10 years early. So that's where she went from a 30 to a 20 year. Sometimes it's the opposite. Hey, you know what? My spouse passed away. This mortgage is a little much for me, but I want to stay in the house. I want to refinance back to a 30 year to lower my payment. Removing another borrower through divorce. Maybe someone bought a house with a co-signer. By the way, staying with divorce, as a realtor, I mean, as a loan officer, I know, you know, Don can certainly attest to this, and Chris, you know, attorneys are good referral sources. Divorce attorneys, just think, you know, of every you know, couple that is splitting up, oftentimes that may be at the very least a refinance to get someone off of the loan or to pull cash out. Might also be a sale, could turn into 2 other purchases. So, you know, I definitely would say if you're in any kind of a network where that's, you know, you've got a friend or family member who is a divorce attorney or something like that. It doesn't have to be divorce. All attorneys have, you know, bump into these things, but that's one just to stay on for a second. Pulling cash out. Maybe it's to pay off a spouse. Maybe it's to pay off a debt. Maybe it's to take a, fun vacation. Maybe it's to buy investment property. Maybe it's to do home repairs. A few months ago, I had somebody who they were refinancing from like a 4% interest rate to about a 6% interest rate. And they were pulling cash out. And at first I'm just sort of like, are you sure you want to do this? And then as we kind of crunch the numbers, once I really look at, they were paying off about $35,000 in credit card debt, which back then their interest rate was like 15, 16%. It's probably up around 20 right now. And it was a life changer. Yeah, her mortgage payment went up about $300, but getting out from under that $40,000 credit card balance, it was a life changer. She knew she was going to staying in this house for I don't say the rest of her life, but she said, hey, this is long term. She was engaged, she was getting remarried, and it really, I went from being a little apprehensive about, do I really want to help this person, turn away from the 4% down, to really feeling good with, wow, once we looked at the numbers, they spoke for themselves, and that's the reason she picked up the phone to call. So just know that we like to play financial, I don't say financial advisor, but look at all the numbers. I mean, Don's talked on a lot of the Tuesday meetings, success stories where he said, hey, this buyer was bending over backwards to come up with 20% down. In the meantime, they had $10,000 in credit cards, a car payment that they could barely afford, where, hey, going 10% down, yes, they got to pay the dreaded PMI, but they were getting out from under so much other in debt that was burdening them and impacting their lifestyle. It could really be a game changer when you open someone's eyes. So, cool. So, 205, I did pretty good there. So I know I kind of felt like I ran through those pretty quick, but trying to keep this tight to an hour. Feel free if anybody has to log off by all means, but just wanted to first off say thanks for everyone for sticking around and for hanging to it. But more than happy to kind of stick around for questions for anybody. Anybody have a favorite one or something they learned about that they didn't know anything about before?
Recast. I didn't know anything about that.
Recast. I mean, it's really become a tool. I have a handful of realtors who have gotten so many people to come up to the line of saying, yeah, I want to buy, but I got to sell first. I don't want to sell my house and have nowhere to go. We don't have family in town. It has been a game changer. Just, of course, saying, hey, talk to Sean and get pre-approved. He'll tell you if this is even an option, and if it's not, okay, well, at least you got your pre-approval contingent on your house to sell. But that recast is really a powerful tool. And I literally, we get feedback and survey post closings. I have a handful where just sort of like, hey, it's something to, this is like a public, endorsement. I forgot what the
service announcement.
Yeah, yes, and a rating and such, but it basically says,
PSA.
So-and-so educated me or told me about this recast, which I never heard of, and that got me into my house. And so many good stories like that. And, the realtor, knowing about these little tricks and tools and hacks or deep cuts, as I like to call them, they can really, get you to the finish line and really help a buyer see short-term and long-term path to get where they want.
This is all good because, especially in this market, I had two buyers, sellers, buyers, selling their house, buying another house, but didn't want to wait to buy the next house. They did a bridge loan. So you didn't really touch on bridge loans, but a bridge loan for them was they just needed it for a short period of time until that house closed. What would be the difference between a bridge loan and a recast or something to that?
That's a great point. And you know what? I should have had that slide in here. So bridge loan, just for those who aren't aware, let's go back to that scenario I started with when the recast. Someone owns a house for 200, they're going to walk away with 60. So what a bridge loan is saying, hey, give me a second mortgage, or it could pay off the first two, but front me the money and the equity from the sale of my house and use that for the down payment on the new house. So that can be used instead of a recast. The downside with a bridge loan, the debt ratio, now you're qualifying with a third mortgage, your old mortgage, your new mortgage, and now the bridge loan. The debt ratio tends to run a little bit high, and that bridge loan technically is another mortgage. So there's going to be closing costs there. So a lot of people, they'll call me and say, hey, I think I need a bridge loan. I'll say, okay, yep, here's what we could do there. And we run through some scenarios and costs. And that's usually where I'll chime in and say, just so you know, we can also do the recast.
Okay.
You know, so they may still have to come up with a little chunk of money, but that is typically part of our conversation. So I appreciate it, Wendy. That's definitely a slide I should have had in there.
No, that's okay, because that's when you started talking about recast, it reminded me of a bridge loan. But now that I know the difference, that's huge. That's a big difference.
Yeah, and only having to work on one mortgage.
Yeah.
You know, we don't have to appraise the old house. So yeah, it could really be a time saver as well.
That's what I was going to say, Sean. Don't you have to get an appraisal on their current house to get equity out of it? It takes forever. Yeah.
I mean, and you got to do title search and all that. Thanks, Carl. Cool. Anything else anybody thought was oh, I know. I'll use the Kellerism. Any big ahas? That's what I should have been. So Wendy, thanks for yours.
Yeah.
Yeah, and you know what? I'm going to jot this down so I see. All right. Yeah, if anybody wants my little presentation here, I'll send this out to you. So I see Wendy and
It's about 10 people in there, Sean.
Okay. All right. I'll you know what? Actually, I might be able to get the list of everybody there and send it to everyone. But,
Yeah, Wendy and Venus.
What's that?
Wendy and Venus.
Okay. Cool.
And Ashok. There's 3 people.
Cool. All right. Any other questions for today? Okay.
Great job.
Hey, thanks for hanging with me. Starting to lose my voice for some reason, so I apologize. If there's anything anyone needs, don't hesitate to reach out to any of us. And I apologize.